Good morning. At this time, I'd like to call the Pension Committee meeting to order. And now, at this time, I'd like to also turn the meeting over to the Alesco Advisors.
Great. Thank you very much. Good morning, everybody. I just want to be cognizant of the time. How much time do you have allotted to us in full? Just
We got about
given
20
the delay, I
minutes.
want to make sure we.
Because of the delay,
About
you got
20
like 3
minutes.
minutes, you got 3 minutes left.
No, you got about 20 minutes, okay?
Could I just for the minutes,
Well, okay.
Can you
that'll
tell
work.
me-
Thank you. I just want to make sure we're
who
cognizant
will
of
be
your time.
presenting to us?
Who will be presenting to us?
Tim Tyndall.
So my name is Tim Tyndall from Alesco Advisors, and Tim Gould, the president of Alesco, is with us
Thank
as
you.
well this morning, and I'll start off the commentary. Good morning, everybody. Thank you for giving us the opportunity to give you an update on the Centro pension plans. I want to just put a little bit of the overall activity in the capital markets in perspective first before I run through the numbers. We had some volatility. We're reporting on the third quarter results here and the historical numbers. We had a little bit of volatility in the stock market at the end of the third quarter. It was September was the worst month in the stock market going back to about March of 2020 when we were in the pandemic lows. The S&P was down about 5% and global
Tim.
markets were down. Well,
Tim, when
Yes.
was the last time you could remember having a good September?
a long time.
Yeah, exactly.
September and October are often negative months. That's sort of historical situation, but I can't recall a September or October being particularly good in the capital market. You're absolutely right about that. But even with that negative slump that we had in September, by the end of the month, the large cap stocks did eke out a little bit of a gain. We did have negative returns for some of the other asset classes. But the volatility came as investors really started to focus on and be concerned about levels of inflation within the economy, brought on by the supply chain issues that all of us have been dealing with, as well as some other issues related to the stimulus measures that have happened over the last couple of years. Emerging markets also had a tough quarter based on some fears about property defaults in the market in China, but some of that may have eased up given some news that we saw today. But all these negative prevailing trends that were percolating around in the capital markets at the end of the quarter did seem to reverse course when the Federal Reserve said and signaled that they would be starting to ease up on some of their bond purchases, the quantitative easing that they have been doing since the pandemic, ease that up by the end of the year, and also move forward their schedule of interest rate increases by about a year. That news pushed bond yields up. We're up around 1.6, 1.7 on the 10-year Treasury now. That impacted the growth stock part of the market, and it benefited the cyclical and small caps. We'll see that in some of the return numbers when we get to that. And even with the domestic market in the last couple of weeks since the end of the quarter has really benefited from strong corporate earnings. And that has driven the PE ratio down of the market. Jim will have more on that when we get to the capital markets review. But the picture recently, outside of that tough time we had at the end of the quarter, has been very positive. So that's sort of a broad overview of what's been going on in the capital markets. And I'll start now with a quick review of the portfolios related to, starting with the non-salary plan. The equity allocation is at 65.2%. The real return assets, inflation-protected securities at 7%, and fixed income at 26%, all within the ranges of the investment policy statement. Taking a look at the equity allocation, a very diversified equity portfolio that represents the 65% equity allocation. About 51% is in large cap stocks, 4% in value, and then the rest is pushed down the domestic capitalization spectrum and the mid cap, small cap, and micro cap, with just shy of 30% in the international market for diversification purposes. And this has been consistent with the allocation that we established at the beginning of our relationship with Centro. We haven't made any changes with that.
Tim, do you envision in the time in the future a switch from the large growth to value with inflationary issues on the horizon or anything?
I missed the first part of that question, but I think it was related to, do we plan to switch to more value given the higher interest rates? Was that the context of it?
Yeah, just reducing the growth and maybe looking at value, and I'm not saying that's the right move, I'm just wondering what your thoughts are on that.
Well, related to the allocation, we have an overweight to value right now, not growth. The growth part of the exposure to the portfolio is just within the S&P 500. So we have roughly half and half. That's a blended fund. So we currently have not had any growth exposure outright in the portfolio. Historically, Alesco has had a tilt to small cap and value in our portfolio versus the broad market. And that is a strategic move or a strategic decision that we have rather than trying to move back and forth between which particular part of the market might be performing better at one time. So we've been pretty consistent with that. And coming out of the pandemic, having this value and small cap tilt has been very beneficial.
Okay, thank you.
Is that? Sure. Just really quickly talking about the fixed income holdings, we've discussed this at previous meetings, but we've continued to hold a shortened duration on the overall fixed income holdings related to the fear that, not the fear, but they're kind of being recognized that bond yields are moving higher. So having a shortened duration will help from a performance standpoint, and we're holding about a 6.1 year duration versus 6.8. And that shortened duration has certainly been helpful. You'll see that in the performance when we look at what's happened in the broad bond market versus the holdings for the pension plan. They've actually benefited from having that short duration. Taking a look at performance, going back to January of 2020, we have the third quarter, year-to-date, and one-year performance numbers. And as we discussed earlier, there was a slight decline in the pension plan in the third quarter, loss of about $240,000. At the end of the quarter, $39.5 million. But that is looking at the year-to-date numbers. So outside of that slight decline in the quarter, we've got an almost 9% return, $3.1 million gain. And as I mentioned, just since the end of September, the capital markets have been very strong, following on with that news related to the Federal Reserve and the rising interest rates. The portfolio is up 2.9%. Equities are up almost 5% since the end of the quarter. And we've surpassed 40.7 million through the 20th of October. So the first couple of months of October have been very positive.
Right,
and
Tim,
then just going back to the September.
Tim,
Yes, go ahead.
slow down a little bit, brother.
I don't mean to keep interrupting you, but we do have some new board members, and I do want to point out our actuarial estimate in order to continue our payments to our existing retirees and keep the plan healthy. We're looking at 7 to 7.25% return. So to have a year-to-date of almost 9, and a since inception when Alesco took over of 14, is quite healthy. And that's helping us maintain our funding percentage.
Is that gonna be for both the non-salary and the
Yes,
salary?
yeah, 'cause they're managed
Yeah, they
nearly
look the same.
identical,
Yeah,
nearly
yeah,
identical.
yeah.
Thanks, Tim.
That's a great point of clarification. Thank you for sharing that. And just to follow up on that, looking at the returns, about 21% for the one-year number, 6.7 million, and almost 8 million going back to the inception, that 14% return since January of 2020. Just covering a little bit about the performance of the individual asset classes, taking a look again at the third quarter. As I mentioned, we did have a negative quarter, down just under 1%. And you can see the large cap stocks were the best performing asset class, and the small mid cap had some negative returns. And then that emerging market asset class down about 8% based on some of those fears from the Chinese property market issues that may be easing up a little bit. We've seen some recovery since the end of the quarter in the emerging market stocks. Year to date, very strong returns out of the equity markets, 14%. Led by the small cap stocks. You can see that. So that exposure to small cap has benefited the pension plans this year at 20% return. But large cap stocks certainly very strong at about 16%. But the small caps tend to lead coming out of a recession and that's what we see have happened so far this year. International markets falling a little bit behind. They're a little bit behind the U.S. In their recovery, still dealing with some of the more severe issues of the COVID crisis and some of the vaccine issues, but the expectation is that will start to turn around sometime in 2022. The one-year performance at 32.8%, led by these more cyclical small cap parts of the market. Small cap, almost 60% return, 43% for mid cap, and 32% out of the value part of the market, which has been outperforming growth this past year. And then back to inception again at 2020, large cap stocks were the best performing asset class through before and to really to the recovery period of the pandemic crisis, and we see that reflected in the portfolio returns here at about 20% return for large cap stocks. But we're in a different environment now related to performance, and that's what we've seen happen since the pandemic recovery. But a 16% return out of equities going back to January 2020. Really quickly, just talking about fixed income holdings, we did have a little bit of a rate increase. Rates went down just a little bit in the third quarter, and we see that reflected in the price of the fixed income holdings. But for the full year and year to date, interest rates are higher than where they were at the beginning of the year and also 1 year ago. And you see how the shortened duration in the portfolio has helped from a performance standpoint when you look at the performance of the Barclays aggregate. We just look at the year-to-date numbers, down about 1.5%. Fixed income holdings are down 1.3%. So that shortened duration has helped, and out to the 1 year number where the Barclays aggregate, the broad benchmark down about 1%, 75 basis points loss on the fixed income in terms of that performance. And then back to inception, fairly close to the performance of the Barclays aggregate. And the last thing I'll comment on, real return assets have outperformed the nominal bond market. Real return assets in the 1 year period have been reflected the holdings of only inflation-protected securities. These are government bonds that adjust their price and principal based on the inflation rate, CPI. And with these higher levels of inflation, concerns about rising inflation, these tips have outperformed the normal nominal bond market. And that's certainly been beneficial from performance and portfolio diversification. Any questions at all related to the performance of the non-salary plan before I move on?
Approximately, what is the distribution rate that the fixed income portion of the portfolio is yielding?
So the yield on the fixed income holdings is about 1.4%. And that's based on an aggregate. The Barclays aggregate is about 1.5. And we've obviously shortened the duration. I mentioned that before with investment grade floating rate bonds. And they're at about 39, 40 basis points in terms of the yield. So when you blend those together, it's about 1.4%.
And that's on a 6.1 average duration?
Correct.
And of the portfolio, and you might have already said this, so I apologize, what's the mix between corporate and government?
In the Barclays aggregate, it's roughly a third between, you've got the three parts of the Barclays aggregate: agencies, government, securities, and the corporates. And it's roughly a third of the Barclays aggregate.
So you're pretty much following the index then?
Correct.
All right, thanks.
Yep. And just to be cognizant of time, I'll move through these next two portfolios very quickly. This is now the non-salary plan. And as someone in the meeting mentioned earlier, we've managed these in connection with each other. They're all managed the same allocation, so you'll see very similar performance. 65% equity allocation, 7% to the tips, and 26% for fixed income. The cash, just under 2%. Equity allocation the same, distribution among large, mid, small, and international stocks between the salaried and the non-salaried. Shortened duration again in the bond portfolio for the salary plan too. Performance, as you can see, the same, a little bit of a loss in the quarter. Gain of 9% for the year to date, 21% for the year, and 14% again, just like the non-salary plan for the inception to date. $38.2 million, gain of 7.7 going back to inception.
Yeah, because they're managed, I mean, relatively the same, Tim. If you want to move on to the last tab and talk about the markets, that's fine.
Capital markets, yep. So the same thing with the UTA plan. I'll just highlight very quickly just the assets in this so you can cover that for the meeting. Again, similar performance. Cash flow is a little bit different in the Utica plan, but we have a year-to-date gain of almost 9% and the 21% for 1 year number, $10.9 million at the end of the quarter. So with that, I'll hand it over to Jim just to cover some of the highlights of the capital markets review.
Oh, thank you. I will do just that. It's good to be with you this morning. Tim, if you go to the next slide, please. So a lot of discussion about valuations in the equity market. What's happened is we're in such a robust expansion of corporate earnings that valuations for the stock market have actually declined year to date. What's driving that is that the increase in corporate earnings has been greater than the increase in the price. So price to earnings ratios, price to sales, price to cash flow valuations have actually improved as the year has progressed. What's driving the profit component is improved margins. Now you may say, well, that's pretty self-evident, but it's understanding what the underlying factors in that. And the primary thing that's driving enhanced margins is the labor shortage, which is we may think of as something as new, but remember that's actually been going on pre-pandemic. Pre-pandemic, everybody had a job who wanted a job, and you couldn't get more people. And then with the pandemic, we have people not wanting to come back to work for whatever their particular reasons are. But so businesses have, for several years, been investing in equipment and technology that has been able to, has allowed their workforce to become more productive, and therefore higher operating margins, higher profit margins have resulted. Next slide, please, Tim.
Jim, what about supply chain?
Yeah, so actually, we've got a slide on that. I'll get to that in just a second. Just a couple thoughts here. Just as is always the case, that we have to watch what the consumer is doing. The consumer level of confidence, as the top chart shows, has been all over the map. But you'll see in a minute that consumption has been spectacular throughout the pandemic, and what's driving that is household net worth moving up. Net worth has increased a lot, first and foremost because of the increase in housing. Secondly, the stock market, people's 401k balances, their personal savings levels are higher. And third, transfer payments from the federal government, which have been substantial. You can see household net worth in aggregate increasing very dramatically from the beginning of 2020 to where we are today. Next slide, please, Tim. Talked about the housing market. Just one little tidbit. The bottom chart here is not suggesting that housing prices are declining. It's the rate of increase has declined. And so we're still, housing prices are still escalating in a very significant fashion, just not as rapidly as they were earlier in the year and late last year. Next slide, please, Tim. So to answer your question about the supply chain. So, with regard to this, I mentioned consumption, the top slide there, you can see the consumers have been very much in the game, really since the transfer payments started to come out with the CARES Act, and that has continued on into this year. That the increase in demand is part of what's the supply chain issues are. So there is more demand than there is supply, so they're trying to get more stuff into the country. And with the shortage of longshoremen, a shortage of truck drivers, we can't get the product distributed. And you've been following what's been going on with regard to the different ports and the ships that are stacked up. This is not a super long-term problem, but it is going to be with us for a while. To give you an idea of the magnitude of the issue, is that a large container ship, it can take as many as 7,000 or 8,000 trucks to unload one ship. And so there's a lot of issues, and then we have issues both with rail as well. So it's trucking, it's rail, and of course it's at the ports. So this is part of also what's driving up inflation. The cost to ship product into the country has increased almost tenfold. At the low end of the range is about eightfold, so 8 to 10x. And that is rising. That of course has to be baked into the cost of the product that you're purchasing and that I'm purchasing. Did that address the question about the supply chain?
Yep, thank you.
Okay, sure. Just go ahead, Tim, to the next slide here. This is, because we're out of time, I'm just going to wrap it up with this. This is really the key issue that investors are focused on is inflation. The Federal Reserve has a relatively sanguine outlook for inflation. They continue to think that things aren't going to be that bad. And they could be right. We don't know. There are a lot of many people who are running businesses, large businesses, don't see it that way. They think that we're going to have labor price inflation for some time for all the reasons you've been reading about, but that we're also going to have inflation issues tied to the supply chain, which we just discussed, and also as we see global demand increase as the rest of the world recovers from the pandemic, just as the United States has been. You're seeing Europe and the UK in the third quarter having higher levels of GDP growth. The fourth quarter, the numbers are supposed to be even greater, and even greater in 2022. That aggregate demand on a global basis is very likely to continue to increase the cost of both services as well as goods. So if inflation is higher, you're very likely to see the skewings in the portfolio that Tim mentioned earlier, smaller capitalization stocks and value stocks or cyclical stocks. Historically, those have been the best places to be in the capital markets when inflation is higher. And the reason for that is they have a very attractive operating leverage in general. They can grow faster and faster than their expenses are increasing, and therefore the profits look more attractive, and investors are more interested in those businesses versus the growth businesses where investors are really focused on earnings several and in some cases many years into the future. So let me just stop. We're a couple minutes over. I just wanted to see if there are any questions before we sign off.
Yeah, hey Jim, this is Nick. I just was curious. You said for those big ships, it takes 7,000 to 8,000 trucks to move that product?
It can, yeah. So what happens is, it depends on what's in the containers and how many containers there are. But one container can take as many as 15 to 20 trucks to unload it, depending on the mass of whatever's in those containers.
Good, thank you. I was just curious.
I don't know if anybody saw the video. I mean, the Port of LA has, I mean, there's 4 and 5, 6 cargo ships stacked out in the water. They're just sitting there anchored. I mean, with a couple hundred containers apiece on them that they can't get to the port and unload.
And they didn't.
Yeah. And one of the things that is a big risk is the longshoremen are in a very powerful position right now should they decide to strike or threaten to strike, because there's very little movement. There's not much room there's no workaround outside of that. So that's one thing that can happen. We've seen a much more union activity. You may be familiar with that, but we've seen more union activity in recent months because of the shortage of labor.
Yeah, and the goods that they can't offload, you're gonna get from increasing manufacturing on U.S. shores, which is gonna push up the cost, push up the price of the goods purchased anyway.
Yeah, and it's, we certainly don't know what is going to happen as it relates to inflation. but we want you to know that we're hedged as it relates to the Federal Reserve's rhetoric on the topic.
Yeah, speaking of the Fed, I noticed one of your slides, that they may begin reducing bond purchases. Do you really think that's possible when they're floating a $2 trillion spending plan right now?
Yeah, we do. We think that specifically they're likely, almost certainly going to reduce the purchases of mortgage-backed securities. The mortgage market doesn't need their support. What they do on the Treasury side is, it may not be quite as aggressive, but they're going to still be buying them, and they're just not going to be buying as much. That's the whole idea of tapering is we're still in an easing mode. They're just not easing as much. It's not quite as dovish. 120 billion in bonds each month. That's having a huge impact on keeping interest rates low.
Very good, very good. Thanks, Jim.
Thank you for your presentation. That concludes the pension committee meeting, Mr. Chairman.
Very good, thank you. Nice job, nice job.
Jim and Tim, thank you very much.